faulty internal forecasting, Jay. I don't know. I mean, just sounds like bad math to me. What about yourself?
Well, it's hard to kind of overstate how much an individual quarter is going to impact Netflix. Obviously, the fear for the market is that this is somehow a secular change in Netflix's growth trajectory. But the reality is they're just a victim of their own business model, which is incredibly scalable. So if they're going to spend $11 billion on content, they're going to spend that no matter how many users they have. And if their subscribers go up by 6 million or 5 million, it's going to be the same cost, but that's another million users worth revenue going forward that they missed out on. So it really helps on the upside to be scalable, and it really hurts on the downside if you miss that forecast growth.
When you look at a 14% decline in the after-hours session in the share price, Jay, does it make Netflix a really strong buy right now, or are you concerned that we may get similar disappointments in the future?
Well, I think it's unlikely that this 14% decline is going to carry over into the open of the market tomorrow. You know, we know these markets are liquid overnight. I bet that settles higher than where it is right now. But if you're really focused on the long-term growth of Netflix, you know, this changes very little about their long-term business plan. And so it's definitely a better entry point than we've had the last few months.
Okay, fair enough. Let's talk about earnings. You know, Friday we had financials selling down, came back overnight. Of course, BAML's numbers were good. We're watching out for Goldman numbers tonight, Asia time. What, in your assessment, what kind of start are we off to for Q2? Because, I mean, we were doing, what, in excess of 26% earnings growth Q1. The forecast is for it to slow down to 21, and everybody is watching the guidance.
Yeah, for most people that we're speaking to, it's really more about the guidance than the pure earnings growth numbers themselves. I mean, 20% earnings is ridiculous. So if they get 21% or 20.5, that's kind of meaningless. It's more about what these companies are expecting for the future. The banks have certainly started off pretty strong, but I think a lot more than people are talking about is coming from the cost-cutting side rather than actual top-line revenue growth. So that's what we're a little bit worried about, and we definitely want to see more of forward earnings looking positive.
Still watching? Perfect. Click here to watch another great video from CNBC International. Oh, and don't forget to subscribe. Thanks for watching.